Benjamin Graham is considered a legendary guru in the investment world. He was born in 1894 in the city of London, England, and passed away in 1976 in New York. Graham developed numerous innovative ideas in the fields of economics and finance and made significant contributions to the investment world. Graham received his education in economics at Columbia University, where he met David Dodd, who would later become his investment partner. In 1934, the duo published their book called Security Analysis, which is still considered a classic for investors today. Graham achieved many firsts in the investment world. Particularly, he developed the strategy of value investing, which involves buying stocks at prices lower than their intrinsic values, thus providing high returns to investors in the long run. Graham also introduced the concept of a margin of safety in investment philosophy. This concept involves buying stocks at prices below their intrinsic values, minimizing potential losses for investors. Why is Benjamin Graham regarded as a legendary guru in the investment world? What is Benjamin Graham's investment philosophy and value investing strategy? What are the factors influencing Benjamin Graham's investment decisions? What is the relationship between Benjamin Graham's student Warren Buffett's investment approach? What advice and tips did Benjamin Graham give to investors? For all this and more, before starting the video, if you're interested in universal economic history, you can subscribe to my channel and turn on notifications to be informed about new videos I upload every day. Enjoy the watch.
Universal economic history.
Graham served as an inspiration to many successful investors, including his student Warren Buffett. Buffett adopted Graham's value investing strategy and expanded it to grow his company, Berkshire Hathaway. Graham received numerous awards and honors for his contributions to the investment world. These include the honorary doctorate title, Doctor Honoris Causa, awarded by Columbia University in 1958, and the Benjamin Graham Award, presented by the American Association of Investment Managers in 1973. Benjamin Graham made significant contributions to the investment world and continues to be remembered with respect by investors today. Benjamin Graham embraced the investment philosophy of value investing. This strategy aims to allow investors to achieve high returns in the long term by purchasing stocks at prices lower than their intrinsic values. According to Graham, investors should conduct fundamental analysis and determine the true value of stocks when making investments. The true value of a company is determined by considering factors such as financial data, managerial strategies, and the future potential of the industry. Graham believes that investors should also pay attention to the prices of the stocks they invest in. By purchasing stocks below their intrinsic values, investors create a margin of safety that protects them against potential value declines. Graham emphasizes that investors should adopt a long-term perspective in their investment strategies. As companies increase in value over the long term, stock prices also rise, allowing investors to achieve high returns. Graham also stresses the importance of avoiding emotional reactions in the investment world. Instead of panicking or making hasty decisions to sell stocks, investors should remain patient and stay true to their long-term investment plans. Benjamin Graham's investment philosophy forms a solid foundation for investors aiming to achieve high returns in the long term. By embracing this philosophy, investors can purchase undervalued stocks with a margin of safety, focus on long-term investment strategies, conduct fundamental analysis, and avoid emotional reactions, ultimately leading to successful outcomes. Benjamin Graham developed an approach known as the margin of safety in the investment world. This approach determines the factors that investors should consider when selecting stocks and aims to minimize their risks. According to Graham, to make a safe stock investment, investors should first examine the financial condition and balance sheet of the company. The financial data of a company helps investors determine the true value of the stock. Graham emphasizes that investors should purchase stocks below their intrinsic values. This creates a margin of safety that protects investors even if the value of the stock decreases. Graham suggests that investors should also examine a company's activities and management strategies. Understanding a company's activities helps investors gain insights into the future performance of the stock. Graham believes that investors should hold onto their stocks for the long term. This allows investors to benefit from the increase in value of the stocks as companies grow, resulting in high returns. Graham's margin of safety approach aims to minimize risks for investors and achieve high returns in the long term. By adopting this approach, investors can conduct fundamental analysis to determine the true value of stocks. Additionally, by creating a margin of safety through purchasing stocks below their intrinsic values, investors can minimize risks. By examining a company's activities and management strategies, investors can gain insights into the future performance of the stock. One of Benjamin Graham's most significant contributions is the development of the value investing strategy. This strategy focuses on investors selecting stocks based on a company's intrinsic value and purchasing them at prices lower than their intrinsic values. According to Graham, the true value of a stock is determined by evaluating factors such as the company's financial condition, balance sheet, sales, profitability, and market position. Graham advises investors to conduct fundamental analysis to determine the true value of stocks. Graham expanded the value investing strategy by suggesting that investors take advantage of market fluctuations. According to this idea, price declines in stocks create opportunities for investors to purchase valuable stocks at low prices. Investors who seize these opportunities can then earn significant profits when the prices of the stocks rise. The value investing strategy is a part of Graham's margin of safety approach. This strategy encourages investors to select stocks by conducting fundamental analysis and trading based on a company's intrinsic value. By purchasing stocks below their true values, investors create a margin of safety. This strategy allows investors to take advantage of market fluctuations by purchasing undervalued stocks at low prices and benefiting from price increases in the future. In Benjamin Graham's investment approach, fundamental analysis is one of the most crucial tools that investors should employ when selecting stocks. Graham believed that fundamental analysis, rather than technical analysis, should be used to predict stock prices. Fundamental analysis involves examining a company's financial condition, balance sheet, sales, profitability, market position, and other factors to determine its true value. According to Graham, investors should conduct fundamental analysis when selecting stocks to trade based on the company's intrinsic value, leading to more successful investments. Graham advises investors to consider not only a company's financial data but also its management quality, brand value, competitive advantages, and strategic management plan. Evaluating these factors together helps investors estimate prices closest to the true values of companies. Graham believes that fundamental analysis not only enables investors to make predictions about the true values of stocks but also allows them to predict a company's financial condition and future growth potential. As a result, investors can make more informed investment decisions by predicting their future earnings and staying true to their investment plans. Fundamental analysis plays a significant role in Benjamin Graham's investment approach. Conducting fundamental analysis allows investors to select stocks based on a company's intrinsic value and make more informed investment decisions. Warren Buffett, a student of Benjamin Graham who was heavily influenced by his investment philosophy, adopted a similar investment approach based on Graham's value investing strategy. Buffett prioritizes conducting fundamental analysis, creating a margin of safety, and making long-term investments when selecting stocks. However, unlike Graham, Buffett also focuses on factors such as management quality, brand value, competitive advantages, and strategic management plan. Buffett's investment philosophy revolves around the principles of reasonable valuation, selecting companies with sustainable competitive advantages, and making long-term investments. According to Buffett, investors should select stocks that are reasonably valued, have sustainable competitive advantages, and hold them for the long term. This allows investors to benefit from the growth potential of the selected companies. Buffett also emphasizes the importance of a long-term perspective in investing. Instead of focusing on short-term price movements, investors should select stocks based on long-term fundamental factors. The investment approach of Warren Buffett, Benjamin Graham's student, shares similarities with Graham's value investing strategy. While embracing value investing, Buffett incorporates additional considerations such as management quality, competitive advantages, and long-term investments. Benjamin Graham, a renowned investment strategist and analyst, introduced the concept of the margin of safety for investors to make secure investments. According to Graham, when investors purchase stocks, they should determine the stock's true value and buy it at a price below that value. This margin acts as a cushion of safety, allowing investors to minimize the impact of any negative fluctuations. Graham suggests considering factors such as a company's financial condition, stability in its operations, and future growth potential when establishing the margin of safety. By adopting the concept of the margin of safety, investors can mitigate the risks associated with investing. Even if the value of a stock decreases, investors are protected by the margin of safety they established during the purchase. Graham's margin of safety concept is an essential component of his investment philosophy, providing investors with a framework to make secure investments. Benjamin Graham, regarded as a pioneer in the investment world, offered several pieces of advice and tips to investors. Here are some examples of the advice he provided. Make rational decisions when investing. Graham emphasized the importance of making rational decisions rather than emotional ones when investing. Exercise patience when investing. According to Graham, investors should thoroughly understand a company and the value of its stock before making an investment. Therefore, investors should be patient and conduct thorough research before investing. Invest in accordance with the value investing strategy. Graham advised investors to invest in stocks that align with the value investing strategy. Manage risks. Graham recommended that investors should effectively manage risks when investing. Adopt a diversification strategy. Graham believed that investors should include stocks from different sectors in their portfolios. This helps reduce risks in the portfolio. Past performance does not guarantee future performance. Graham highlighted the significance of focusing on the future potential performance of investments rather than relying solely on past performance. These pieces of advice are some examples of the guidance provided by Benjamin Graham to investors. However, Graham's contributions to the investment world extend far beyond these examples, offering investors various strategies, methods, and tips to achieve long-term success. Thank you for watching my video. If you liked it, please hit the like button. If there's a specific video you'd like me to make on economic history, don't forget to mention it in the comments section. I wish everyone a pleasant day.
Universal Economic History.